So we're looking at a problem here for accounts receivables, and we're looking at number 12 there. And what we have is this right here. Some things are previously written out. And the reason that we're going through it is to make sure that we don't just have numbers, but that we understand the story that goes behind it. So the problem reads as such. At the beginning of the period, this company had balances of accounts receivable of $187,100. And they also had allowance for doubtful accounts, which we will talk about later on. So at the beginning of the period, we had $187,000. During the period, we had net credit sales of $176,100. And we had collections of $699,230. What does this mean? This here is part of a solution that's going to be given, and if you choose to look on that, that's great, but I don't want this to just be debits and credits. If we understand the flow of what's going on, it'll make sense later on. So, at the beginning of March, we had $187,100. Beginning of March, okay? Beginning of the period, we're just going to call it March. So I'm going to put this up here in this color red because I want to distinguish between the two periods, okay? There is something that happens during the period, during the period. There's something that happens before. And that's going to be important to understand what all this means, even what the journal entries mean. Now, as I was showing here, we have cash sales of, we have receivables of $767,000, okay? $767,100. If all we did was credit sales, then this would be our journal entry. If all we did was credit sales, this will be what we debit and this will be what we credit. But sometimes, and we have cash sales. Like if you go to Walmart, you will give maybe a little bit of change and then you put the rest of it on your credit card. So we have to remember that there is a component of this that may also have to do with cash sales. Not for this problem, but let's just say that you had $1 million in cash sales, then you would have total revenue of that. The whole reason we're putting that there is just to show that we could have had some cash sales, but we're only dealing with revenues. We still good? Okay, now, it's important that we understand what happens before the period, because if we don't, then when we start talking about collections, it's going to look weird, okay? So once again, at the beginning of the period, the company had accounts receivable balance of $187,100. And they had an allowance account for $8,500. During the period, what we have in blue, with the exception of that $1 million, during the period, we had credit sales and we also had collections. So, now we're going to talk about debits and credits, okay? And let me take this off because, once again, this was just for example, that part right there, but we'll keep the first journal entry that we have. What does this mean? We know that in order to increase accounts receivables, do we debit or credit to increase accounts receivables? Do we debit it to increase accounts receivables? That's right. Okay, good. So this is why we have an accounts receivable balance right here. This is accounts receivable balance sales of this amount right here. Now, we're not working with revenues. Obviously, I'm for a journal entry, but revenues, we would credit that, so that's what we would have, okay? Now, this is for this journal entry. But what about before the period? We still had something in our balance. What I want us to do is to think of this right here as a cup, and I will draw that cup in just a second. But this is what we had. Sometime, I'm just going to say from January through February 28th or 29th, depending on what month it is, okay? On what year it is. So, we understand that it was a bunch of things that were debited to accounts receivable before we ever started this month, right? And then during this month, we had a bunch of credit sales. This is not just one number, I guess. This is a whole bunch of sales that happened that added up to be $767,000. Are we still okay so far? Okay. Now, why is this important? Because we're also going to collect something. So let's see when we start to collect it. Right now, we said we have collections of $699,230. So let's just kind of add this. If somebody give me a total right here, what is my total for this right here? If I add my 187 and my 767, what is my total? $954,200. Okay? This is my total. of whatever date we are. So in total, this is what we had for the month. Okay, we're just going to assume we're not going to make any more sales, that we've met our quota, so we're just going to stop. For this month, this is what we have now. When we say we had collections of $699,230, do you see how this worked? Out of everything we previously sold, plus what we sold this year, we're collecting $699,000 of this right here. Everybody okay with that? Why are we collecting so much? I don't know, but let's always make up a story to go along with it. We had sales this much for the first 2 months, right? But then what was this month? Spring break, right? So we have a place where everybody wants to go, and we know that. And so we had a lot of sales, right? A lot of sales. That makes sense, right? Spring break, the sales went up. And so in total, this is what we have. Also, during the month, we're going to collect a whole lot of that. Now, I can't tell you if they collected all of this or part of that. That's what we talk about with the aging accounts receivable. But what we do know is that out of all of this right here, they collected $699,000. So for that reason, do the collections increase our accounts receivable, or does it decrease? Who says it increases? Who says it decreases? Good job. So that means that we credit it to show the decrease right here. Okay? So the credit will be to that. Now, we have to do a journal entry that shows that it happened. When we collected it, keep in mind that there are a lot of different ways to pay. Now, we're talking about cash, but understand that if I owed you $1,000, right? But if I offered to give you a Lexus instead of $1,000, when you take that, that's a full payment. So understand that, we're talking about cash, there are other ways to receive it, okay? I may forgive you of a liability you owe me. Just understand there are different ways to pay. In this case, we're going to receive cash. They don't tell us that, but we know from previous experience that we're going to talk about cash. So we're going to have collections of cash for $699,000. And we're also going to do what? If this related to you, and if this was part of the balance, don't you think I need to reduce my accounts receivable by that much? So I'm going to reduce it with the credit because of that, okay? So accounts receivable is going to go down here by the same amount that I collected. So if we just talk about only these right now, this is what we journalized. We did not have to make a journal entry for this because these journal entries were made January and February for each individual sale. But now, because we have these new sales, we have this new bunch right here. So this is for collections in March or during the period. And this here is for sales during the period, or as we're saying, during March, okay? Is everybody okay with this so far? Because it's sometimes just weird. That solution was given, and it means something now, right? It's not just about what we had. So is everybody okay with that part so far? Okay? Now, I'm going to erase this because we know what it is, and I also need some more space, but we'll just say that obviously this is the first entry right here, and then the next one we're going to do is the second one. Now I'm going to deal with the rest of this, all right? We're going to deal with the rest of this that we talk about with writing off different things, okay? Here's the next thing we're going to deal with. The problem says, during this period, it wrote off as uncollectible accounts receivable $7,528, okay? $7,528. So understand that we have a beginning balance and we have a sales balance that we previously had. Excuse me. We have a beginning balance and we have sales for the period. We're good with that, right? So this write-off, we just sold this, so we probably know that we're going to collect most of it. So we're just going to assume that most of this came from right there. So out of all this $954,000, you don't have to write this, but this is just for, make sure you write a different color here. This has a bunch of different items. You may have $10,000 in there. You may have $7,528. That sounds familiar, right? You may have, the rest of it may be an $800,000 sale. The thing is that this makes up a lot of different transactions. We agree with that, right? Makes up a lot of different transactions. The only one we're concerned about is this one right here. This $7,528. This is the transaction that we're going to write off. So out of all of my credit sales, we've determined that $7,528 will be written off, okay? $7,528 that will be written off. So you see where this comes from? Now, don't get me wrong, we could have mistakenly sold it to someone who was not able to pay or didn't want to pay. Doesn't really matter the reason. It comes out of one of these, and we're just going to assume that it comes out of the whole bucket, okay? So everybody still good with that so far? Okay. The green is going to be a little bit difficult to see, so I put a green asterisk by this one right here. In order to write that off, that means that we're going to reduce the accounts receivable that is being owed. If you know you're not going to get this for me, why are you recording this right here? Why do you keep it right here? Think about it this way. If I tell you I have $954,000 in my pocket, right? If I tell you I have it in my pocket, right? But you already know that I'm not going to collect $400,000. How much? What's the most that you can let me have? More than $2,000. What's the most that you can let me have now? You can only let me have about $500,000. I told you, looked at my books, $954,000, but you know that I can't collect $400,000. So the most I can really give you, the most you're probably willing to give me is $500,000, if that. The thing is that we have to show that if we can't collect it, then we need to tell people that. And we're going to do that through this journal entry right here. So at the very least, we know we're going to debit something and we're going to credit something. So there's my space for my debit, and here's my space for my credit. We know that my credit is going to be to accounts receivables, okay? So it's going to go to accounts receivables for $7,528. That is my credit, okay? But I also have a debit entry, right? How do we come up with the debit entry? Last time we talked about a theory, right? It's March, and let's apply the theory now. It's March now, and we can write off what we sold this year against March. Or we can write it off in the period that it happened. We're assuming this happened previously, right? So since this right here is probably related to these sales right here, don't we want to show investors that we had a really good March? We don't want to show them that it was tainted by anything, because these uncollectible accounts related to February sales. Let's think of it. These uncollectible accounts may have been related to Valentine's Day gifts, right? But all of our spring break stuff, man, we have a good month every spring break. So you can trust us, you can come to us. So in order to make sure that it stays in the period where it belongs, instead of, don't write this part down, instead of debiting bad debt expense, instead of doing that, we're going to take out of an account called allowance for doubtful accounts. I have to abbreviate there for that amount, okay? So we know, once again, that when it says that we're going to write off $7,528, that it comes out of previous month's sales. These are Valentine's Day gifts that were returned. We want to make sure that what we did here is intact. So we've already made allowances for that previously. In order to show that, we're going to take it out of allowance for doubtful accounts. If this was my books, I would put -February, because I knew where it came from, okay? Now we have one for the next month as well. So it's not going to come out of bad debts. It's going to come out of allowance. And the reason we use the allowance account is to make sure that whatever happened in the previous time stays there, and whatever happens here stays here as well. So that's this journal entry right here. The green portion, okay? And that would probably be entry number 3. Does that make sense what's going on so far? All right, let's continue here. We wrote that off, right? However, remember that we have this bucket of money right here. We wrote off this part, but guess what? This makes up a bunch of different things, right? This makes up a whole lot of different stuff. We may have a $5 sale here. We may have a $17 sale. We may even have a $3,284 sale. That sounds familiar, right? That's this sale right here. So you see that has a bunch of different things in there that we wrote off, right? All these relate to Valentine's Day. So now what we're going to do? We see that account that was previously written off right here. Part of that account that was previously written off. This includes the $3,284. This includes this part of this. Part of that is going to be collected. How does that sound? Remember last time I told you, if you let me borrow something, I can go outside and get hit by a Mack truck. Remember I told you that? Remember that? It happened. It happened. I went outside and got hit by a Mack truck. So they buried me, and this is my ghost talking right now. They buried me, and you got word, and you wrote that off. This is related to me, right? This is related to me. But then my family got the insurance money, and they said, you know what? Y'all was such a good business. We want to give you a part of that money. So you see how these things happen? It may not be that. I may have just got my taxes back. And I've said, you know what? The right thing to do is to give you some money. For whatever reason, you're going to now recover a part of that, right? But what I showed you last time, I showed you that when you recover something, there's always going to be two journal entries. We're always going to have two journal entries to recover something, okay? So, in order to recover this, I have to do two things, okay? There are two things I must do. One thing that I have to do is to reestablish the account. Because when you wrote this off, when this was written off, this was no longer a part. This was no longer a part of your books. You are now down to, you had this plus this, minus this, minus this. That stops right there. That's what you had, okay? Now all of a sudden, you're going to collect this right here, but you can't just come in and make a journal entry to collect. There must be two things must happen. You have to reestablish the account. So here's an entry to reestablish the account, which means that you have to put accounts receivables back on the books. Excuse me. Yeah, put the accounts receivable back on the books. And you remember you took out this bucket, allowance for doubtful accounts. You have to put that money back in there because that was related to possible write-offs due to Valentine's Day sales that we had. So put the allowance back on there. Do you put it back on for the full amount, or do you put it back on for the piece of that you're going to recover? Only for the piece that you're going to recover. So put that amount back in there. Because now my name is back on your books that shows that you can collect it. Otherwise, you would have just had a bunch of money in there and you would not have known where it came from, okay? And then once it's there, you can actually write down that you collected the cash, and you finally, for the last time, wrote off the account receivable for the $3,284. Does that make sense there, what's going on in terms of it's not just the numbers and everything? And what does it have to do right here? That's why we can, first of all, maybe we have to put it back on the books. We have to put back on the books what we collected and put back on the part that we recovered. So that's why we have this in two different places. So, first of all, are we okay so far? Can everybody see that? That was a little bit low. Right here, this first part here is this journal entry to reestablish where we debit accounts receivable and credit allowance for what the amount it is. And then we can come back and write the collection portion for debiting cash and accounts receivable for the same amount, okay? So we've done our work. We made there are a couple more journal entries, but this is kind of show you what's going on here. We've done our work. But what if all you have was this right here? You can still know the story. This is you. This is you at the finance meeting. Coming into the month, we had $187,000 of sales from February. Most of that was due to Valentine's Day. This month, we had a whopping $776,000 because we had an excellent spring break. We also were able to, believe it or not, collect most of it, even though some of it came from last year, $699,000. But unfortunately, we had to write off $7,528. Fortunately, there was a guy that got some income tax money back, and he decided to pay us, so we recovered that, and then we wrote it off. And our ending accounts receivable balance out of all of our credit sales is down to $247,000. How's that sound? So this is what you do to get to right there. So when you see that solution, think of that solution as it's something that's just kind of telling the story of what's happening, okay? So any questions on that part right there? Was that helpful for you? Because it's easy to get caught up in those numbers, but sometimes just knowing a little bit more about it will be helpful for us, okay? Now, let's go to a different concept here. And the concept we're going to go to is the allowance for doubtful accounts, okay? Let's go to problem 3-3. I think, yeah, we can still see the name. I don't want to put it up here. If you turn to your books or to your homework to brief exercise 8.4, you can look in your homework at brief exercise 8.4, okay? And keep in mind your numbers may be a little bit different, but we're going to use this right here so we can understand what's going on, okay? Is it okay if I erase this right here? Okay. All right, so we're going to talk about now allowance for doubtful accounts. Allowance for doubtful accounts. I'm abbreviating that, allowance for doubtful accounts. All right, now, as we talked about, to increase our accounts receivable, we always debit accounts receivables. When we write off this portion of the allowance, why do we do this? As we just talked about, the reason for using the allowance is to say that whatever happened in a certain period, if we have to write off part of that, we want to always associate it with the period that it is in. That's why we do accrual entries, okay? This is why we do accrual entries. So the way this problem reads is that at the end of the year, there was a company, it's always from your perspective of your book, of your company. The company had an accounts receivable balance of $697,200. It also had an allowance for doubtful accounts balance of $22,590, okay? Now, there are a lot of different ways this can be done. In this case here, they're just simply telling us that we have an accounts receivable balance, of $697,000. So I'm going to do a quick calculation for you because it's not included here. If you were to take $22,590, and if you were to divide that by $697,200, you'll get approximately 3%. A little bit more, but 3.24%. So 22,000 this is a calculation. $22,590. This is what my allowance account is, divided by 697,200. it's going to equal approximately 3.24%, okay? So that's what's in there. The reason I'm telling you is this right here. There may be some times where you'll see there were sales of this amount, and we estimated that 2% would not be collectible. We estimated that 5% would not be collectible. Where do we get that from? A lot of times it's going to be based on our company's prior history. You know, based on there's some people that you're going to borrow money to, that you're going to let borrow money, and you know they're going to pay you back, right? What about those other ones, right? Now, what percentage of those people that you let borrow money not going to pay you back? You would probably know based on previous experience that it was 3.24%, whatever it may be. So if you just had, this is just for example, if you loaned someone or you loaned out about $750, based on your past experience, you may know that 5% of those people are not going to pay. What's 5% of 750? That's about $37.50. Okay? So if you were just given a percentage that says that 2% won't be collectible, then you would go to your accounts receivable balance, you look and see, I let $750,000 go back. So I already know. Why do we have this? Because you can't go telling people that I'm going to have $750 by Friday when you already know that you're not going to make that $37.50. Okay? So it may be given to you sometimes, and it may be asking you to go in and compute it yourself. Okay, so we understand the difference between those two. And where does this come from? Most likely the history of your company. If you've never been in that business before, then what you may do is to maybe go to the internet is always a good place. If they will tell you sometimes, you can go to the corporate financial statements of people. They may not tell you exactly what they come up with, but you can kind of figure it out sometimes. But either way, it's based on your history or someone else's history why we have that. Now, this was given. This number was given. I was just showing that this could have been a percentage, and if we had a problem like that, then we would have to go in and compute our percentage. Because we're going to come up in a little bit, we may have something like $100,000, and we may say that during the first 30 days, we have, during the first 30 days, 2% is uncollectible, okay? Just based on your history, it may be something like that, right? And then you may say for the next 31 to 60 days, obviously the longer it goes, the more likely you're not to get it, right? So do you think this percentage is going to be more or less? It's going to be more. So it may a little bit more maybe, but it may be up to 3%, right? You haven't heard from this person. You can't, but you kind of have, there are different reasons why, but we're going to give them the benefit of the doubt. Now, by the time it gets to 90 days, 61 days to 90 days, you may be like, man, every time somebody owe me money over 3 months, it's a 10% chance they're not going to get it. Why do I say that? Because there may be a time when you have to come down and you'll say, well, this is my accounts receivable balance right now, okay? Now, this is not part of this problem, but I'm kind of using it to make a point. Right now, that's my accounts balance, right? But then when I go in, I already know that this balance, this is over the last 6 months, just to make a point. Over the last 6 months, okay? So we had sales from recent sales. We had sales from 3 months ago, 2 months ago, sales from 3 months, and sales, just a whole bunch of sales. But out of what I have, I know that I will not be able to collect 2%. So I can reduce my balance. I can make an allowance. This is the day. I don't know what's going to happen, right? I have to make an allowance for what might happen over here so that everything that happened over here will stay over here. I have to make an allowance for what I may not collect over here for everything that I sold over here, okay? So this is our best guess. It could be 2%. So I know that even though I have $100,000 out of my current sales, I know that I probably will not get $2,000 of that. I'm probably not going to get $2,000 now that's not okay, but I just based on history, I'm not going to get that amount. Then, if this is out of the same amount there, obviously we would know exactly, we would have a number to apply that to, but in the absence of that, 3,000 won't be there, and then we know we won't have 10,000, okay? So if we just stop right there, obviously you can go on out over that, but if we stop right there, then we would estimate the estimated uncollectible amount would be $15,000, okay? That's the estimated uncollectible amount in my allowance for doubtful accounts. Is everybody okay with that right there? Okay, so we did all these sales, 100,000 sales up to this point. Today is whatever today's date is. Now, we had someone called us, hey, how much do you really expect to receive? We already knew that, out of this amount here, and of course this can be broken down, maybe 5,000 this month, whatever it is. We take 2% of this, 3% of this, 5%, 10% of that, and we have a total estimated uncollectible accounts, which means we really expect to collect $100,000. How about $85,000? Do we expect to collect $85,000? Right, okay? So now, once again, this part isn't on that, but it's kind of showing us how we got to that point. So now let's go here. Let's think about our balances again. We have our accounts receivables. And we're going to go back to the debit and credit thing. We always have to end up there, but we want to understand what's going on. An allowance for doubtful accounts. Now, how do we show an increase in accounts receivables, with a debit or a credit? We know this one, right? With a debit, that's right. Okay, so we'll show an increase right there. What does allowance for doubtful accounts do to this? Does this increase or decrease my accounts receivables? It decreases. Therefore, it will have an opposite, we will have to do the opposite thing to show the decrease, which means that to show an increase, see I'm increasing my allowance for doubtful accounts, to have an increase, then I'll have to credit that right there. So this on the credit side, this is on the debit side, okay? So right now, as of this date, I have $2,000 in here. And this is unfortunate, but we have to put it here. We have to estimate how much will not be collected. $10,000 there. And I have a balance of $15,000. Okay? So my allowance for doubtful accounts has a balance of $15,000. We know my accounts receivables, that was $100,000. That's not going to change. Remember, that's a whole bunch of different sales in there, but that's my balance right there. Okay? Now, if it gets to a situation where I know, or where I'm not going to pay, you have to take it out of here. You have to take it out of here and reduce this account by the same amount. Okay? Does that make sense? Which basically gives us our journal entry, okay? So you're going to take it out of here and reduce that account by the same amount. So it's only, doesn't matter what category, let's just say it comes out of this middle one here. If it just happens to be, $275 that we're not going to receive, then we have to take $275 out with a debit to the allowance. And why is it a debit? Because it is decreasing amount in there. And we're also going to reduce our amount over here by $275. Okay? So how do we show a reduction in accounts receivables? By crediting accounts receivables. How do we show this amount here? By taking it out of there. Everybody still good? Okay. This is only related to one account. But if, for some reason, I'm kind of reinforcing something, if for some reason I'm able to repay this, that's good, right? So what do you have to do? You have to, first of all, put it back on the books, because say if I just don't put it back on the books. If I record some cash, what am I going to credit, first of all? It's not revenue because it's not a new sale. We don't know what we're going to credit. So we have to put back on the books what we had, what we previously took off, which would be the 275. And we got to fill this back up because this was estimated that we were going to do. So now I have to put it back over here. Now, obviously that was a deduction, but these two cancel out, which means I'm still left with a $15,000 balance. Think about it. This is what you expect not to collect, right? Then all of a sudden you found out I couldn't pay. That dropped your balance from $15,000 to $275, right? I mean, that dropped your balance from $15,000 minus $275, which left you with a lower balance, right? But now since I've been able to pay, you previously took it out, you put it back in, these two cancel, and I'm back to this right here. This is a guess. I don't want to write this off. So I want to fill this back up because I don't want to write off in the first place. This is not real money, if you want to call it. This maybe play money, whatever you want to call it. But I want to fill this back up. Same thing here. I was not going to pay, well then I am going to pay. These cancel out. And of course, when I do my final entry, which is to finally get rid of that 275 again, then it's going to result in that right there and a debit to cash, okay? So in that case, because I'm going to pay again, I'm going to have $100,000 less 275, which is going to be $99,000 and some dollars, okay? So does that make sense in terms of what we have? Because I'm going to do one more demonstration just to show it, to make sure we understand what this allowance for doubtful accounts is. All right, so let's think of allowances for doubtful accounts as just a cup. It's a cup, okay? My cup, right? Now, $15,000. We expected that we were not going to collect $15,000. This is my allowance for doubtful accounts, okay? So, let me write this a little bit bigger here. Same picture, just make it a little bit bigger. This is my allowance for doubtful accounts, right? Or this cup, okay? So, I sold for this example here, $100,000, right? This is how much I sold, right? We're good? We're good on that part so far? Now, how much do I expect not to collect? Keep in mind, I know that this is halfway, but in order to emphasize this, I need to give a little bit more room. This is the $15,000 that I am not going to be able to collect. That's this amount right here, okay? This is the $15,000, so this is what I will not be able to collect. That's my allowance for doubtful accounts, okay? Now, it just so happened that I could not pay this. So, since I couldn't pay it, I took it out of my allowance for doubtful accounts, right? So, I'm going to get rid of this here, which means I'm left with less that I can quote unquote afford to write off. Now, just imagine if I write this much off, I'm going out of business. Not true, but to get the idea. This is what I have left, right? But then, for some reason, I'm able to pay, which means that I can feel this, that since I can pay, then you can put this back in here. You can say, well, I can afford to write off a little bit more, so now your allowance for doubtful accounts is back full again to $15,000, okay? And you can now still afford to write off $15,000 and not go out of business. Now, it doesn't mean you're going to go out of business, but that's just to emphasize the point, okay? Does that help out with those different ways to look at it there? Okay. Now we can look at the problem. We can look at the exact words of the problem here. This is brief exercise 8.4. At the beginning of the year, they had an accounts receivable balance of $697,200. And they had an allowance account for $22,590. Later on, January 21st, it was learned that the accounts receivable from Madonna Incorporation is not collectible, and they authorized a write-off of $4513. I'd like to see you come up with a journal entry to tell me what the journal entry should be to show the write-off of $4,513. Can somebody tell me that journal entry? And by the way, on March later on, they're going to record it. So I tell you what, they're going to record a payment. So I tell you what, instead of writing all what happened at first, let's just stick to this problem here. And all they want to do is to know, do you understand what to do in terms of journal entries when someone says they're going to pay later on? When someone says they're going to pay later on, what do we have to do? We have to obviously record it in our accounts receivable, right? Or put it back in and then take it out. We also have to refill this. But what's the journal entry going to be? I have to do two things. It's always two things when someone says they can pay. Number one, when you write it off, you took it completely off the books. You did not even know that I existed anymore when I said I couldn't pay. Then I came to you. That means you have to put back on the books the accounts receivable and fill this cup back up to total blue, right? So you have to fill that back up. What's the journal entry for that? There are two journal entries. Before I can ever record the receipt of cash, I have to put the receivable back on the book, which means I need to debit what? Accounts receivable account. That's right. I have to debit accounts receivable, and I also have to fill this cup back up by crediting what account? The allowance for doubtful accounts. So my journal entry, whenever I recover something, my journal entry is going to be debit accounts receivable to put me back on the books, and then credit the allowance for doubtful accounts to fill this cup back up, to fill this balance back up for the amount that is there, which is $4,513 in this case, okay? Now, since you put me back on the book, you can record what I pay you, right? I'm paying you in cash, so what do I debit? That's right, debit cash, okay? I debit cash. And now you can finally remove me from the books by crediting accounts receivable. That's right, accounts receivable. Both of you, good. Accounts receivable for the same amount. And so what you would see is that exact journal entry in that place. I like how they actually give you a head start. One of them says to reverse the accounts receivable. That means basically putting it back on the books. And the other one is to record the collection of accounts receivable. We know what that is right there. Okay? Everybody okay so far again? All right, let's see what else we have here. All right, the next one we're going to do is BE, Brief Exercise 8.5. BE, Brief Exercise 8.5, okay? This last concept we're going to cover is actually setting the allowance up at first in your book, okay? Actually setting it up at first. We talked about what it means. We talked about how to get there. Now we want to say, how do we set it up in our books? What journal entries do we use? And it's still going to come back to the why of everything we did, right? But now I think it'll make a little bit more sense because we can see exactly why we're doing this entry, okay? And so if you have some extra time, look at those solutions with those T accounts and just, say to yourself, this is what it means, or this is not what it means. When you're driving or something like that, or whatever, you have some extra time. That way you can kind of get a better feel for it, okay? BE, brief exercise 8.5. Novak Company uses the percentage of receivables basis to record bad debt expense. Percentage of receivables. Remember we just did a small example. We sold 100,000 and we said this much, and this much. So it's the same kind of thing. Some people use percentage of receivables. Some people use percentage of sales. If you have all credit sales, that's one thing. But otherwise, you can use percentage of receivables. So we have to understand that this is an adjustment to accounts receivable, right? It's an adjustment. It is also known, think of it as an accrual, okay? What does an accrual do? An accrual makes sure that everything that happens over here stays in that period, and everything that happens over here stays there. So even if I have to do some work over here, it's not going to reduce or add to what I did in this period. So that's why we do it, okay? So we're saying that 2% of accounts receivables will become uncollectible, okay? So accounts receivable, we have an accounts receivable balance of, I'm not going to debit or credit, I'm just going to write them out here, of $395,200. $395,200. This is my accounts receivable balance, okay? Now, we're estimating that 2% of this will become uncollectible. How do I compute that? If you don't have a calculator, just tell me how to do it. How do I come up with a number to show that there's 2% that I'm not going to collect? Do I add something?
If you're trying to find the 2% that you don't collect, wouldn't you multiply that by 0.02?
Perfect. Multiply by 0.02, which is the same as 2%, 0.02. And when I do that, I will be left with, I will have then my uncollectible account. So this is the balance. This is my percent uncollectible. Okay, my percent uncollectible. And so my total uncollectible will be how much? $790, okay? Good, $790, okay? So this is my percent uncollectible, right? Now, I have to put a journal entry in. But before I do the journal entry, I have to think about something, okay? This is $790. Previously, I had a balance, previously I also had a debit balance in my allowance account of $864, okay? So, let's see how we get these answers here, all right? The first thing we're supposed to do, the very first thing is we're supposed to prepare the adjusting entry to record the bad debt expense for the year. Now, once again, the percentage of receivables account records bad debt. Let me do one quick thing. I'll say this computation for me. All right. And I missed the number that you said. I was supposed to put a 4 on there. I missed your number. I'm sorry about that. This should be 7,904. That's my fault. That's my fault. Okay. $7,904 what we have now. I have to make an entry in here. One thing you have to understand is that this is an adjustment to a current account. I'm doing this on this side because it's related to this year. All right. Now, this is going to call for an accrual entry. This calls for an accrual entry. And one thing we know about accrual entries, you must have at least one income statement account and one balance sheet account. It doesn't have to be in a particular order, depending on what you're doing, but you have to have at least one of each. Got it? So we're already familiar with accounts with allowance for doubtful accounts. So we know we're going to have it here. We're going to not put the amount, but we're just going to put the account here as a credit. So allowance for doubtful accounts, I'm just going to write allowance, is going to be a credit. Okay? And we'll put the amount in a second. Now, anything that you can't collect is really an expense. There's a name for it. We haven't talked about that name yet. The name of that is bad debt expense. So allowance for doubtful accounts is a balance sheet account that we credit, and it goes against accounts receivable. But then we have to record the other thing. The other thing is an expense. That is an income statement account. Remember, income statement accounts are revenues or expenses, or some combination of those, okay? In this case, there's only one thing. That's a bad debt expense account. Now, we won't have to prepare an income statement, but let's don't forget that we have revenues minus cost of goods sold gives us our gross profit, minus our sales returns and allowances gives us our gross profit. And then we go to our operating expenses, get our income before operations, and we finish with our other expenses and other revenues. Remember, those other expenses and other revenues have to do with things that you don't normally do. So if you sell an education to school and you have a football team, that you can make way more money off the football team, make way more money selling stock or whatever, but anything that doesn't have to do with your business is over there. This bad debt expense comes under operating expenses because you sold this out of these are regular operating sales, and you have operating bad debt expense. So this is an operating expense, bad debt, okay? Now, the question is, do we put $7,904 in? Let's look back at the problem because there's some more information here, okay? Now, it says accounts receivables are $395,200. That's the balance at the end of the year. And the allowance account had a credit balance. It says, and the allowance for doubtful accounts has a credit balance. I'm going to insert one word in there. And the allowance for doubtful accounts already has a credit balance. Why do I say that? Because this is the amount that we expect not to collect off of this, right? That's the amount we collect. The thing about this 2%, if we're just, now in real life it can change, but we're just assuming that you should never have no more than 2% uncollectible. I mean, I think that's reasonable, right? If you have more than 2% uncollectible, you might start doing other stuff, but there's some businesses that may have a little more. The goal of the allowance, the goal of the allowance account is to never exceed, in this case, the 2%. I never want to have more than 2% in here. I never want to have more than 2% bad debt anywhere. Can the whole country default? Yes, they can. But that's a different situation. I want to make sure I never have more than 2% in there, okay? So, I have, by the way, this is a credit balance. Remember, we're going to credit this in the end, but since I already have $2,657 in there. I already have that in my allowance account. If it's already in there, then by the way, it is a credit, okay? So I already have this amount in there. I already have that in there. I know that at the end of every period, I can have no more than 2% in there. In this case, 2% is this. What if the number went up? What if it was 900,000? I could only have no more than 2% of 900,000. See what I'm saying? If I make less sales, no more than 2% of that. So at the end of the period, no more than 2% already, no more than 2% in here. 2% gives me, I need you to say this number. How much does 2% give me? 7,000. I can have no more than 7,000. I already have how much in there? 2,000. Can this number be here the same? No, because I can never have more than this in here. So to get the amount, then I have to subtract the 2 in this case, okay? So when I subtract the 2, what do I come up with? Because that's going to be my number that I have for bad expense for this period.
$5,247.
$5,247. $5,247. That is the amount that I should have there, and that is correct. So remember, the percentage, when we use the percentage method, I can never exceed the amount that's related to the percentage for this year. It is 2%, okay? So that we understand where this came from, 2% will give me this amount right here. I can never exceed that. So in order to make sure, now think about it. I already had a credit of 2,657. I already had a credit, right? Now I have a credit of this amount in here. When I add it up, doesn't it add up to this right here? So the goal is to make sure that I never exceed 2%. I never exceed 2%. If it was $493,000, it would be 2% of $493,000. Okay. Now, for the sake of time, if we had to reverse this, then we would have to make other adjustments. It will be from the debit side. Okay. So the goal is to always have this much in here. If it was a reverse question, we would do it that way. Okay. Now, that's the next part of this right here, which is if they had a debit balance. So for the sake of time, we won't be able to do the debit balance, but if they had a debit balance of 874, instead of, and maybe we can get it, if this were 864, if this was $864 debit, if it was an $864 debit in my allowance account, if I started off with 864, right? We agree? Because that's what the debit is, right? How much do I have to end up with? That number has already been established. How much do I have to end up with? No more than 2%. So the most I can end up with would be what?
Unless you could end up with that 79,
This-
79.4.
That's right. This is the most. This is my solution right here. 7904. What does this mean, first of all? This here means anytime it's a credit, it means that I expect not to receive this much. This means over here that if I have a debit, if it's a debit, it means not only did I use that, but I also use more than that. Which in this case would be this. So in order to bring this back right, I would have to add those two together, and what I would get would be $8,678. And at that time, I have to change my entry here to $8,768. $8,768. I have to change my whole entry. Why? Because this went over. I can have no more in this right here. Does this mean we're going to Does this mean that we just hoping and praying that they don't pay? That's not what it means, right? So if we already not wishing and it's going over, we want to make that adjustment. So the only difference is that we will now credit for this amount because we have to put that back in there. If we go into that bucket we had, we went underneath that bucket, so we have to probably back up, get a bigger bucket or something like that, okay? And so that is the allowance for doubtful accounts in terms of everything, and hopefully it will be a little bit more pleasurable to look at this point in time. One more thing,